everyone. Welcome to the Getting Sharpe podcast presented by Omega Point. I'm Omer Cedar, CEO and co-founder of Omega Point, and we've really created this podcast to help our investor community understand some of the most relevant topics that are impacting institutional investors in this current market environment. I'm excited to introduce a special guest today, Sheldon Simon, founder and managing partner of Third Gear Investments. It's a really interesting fund focused on a pragmatic approach to investing across all areas of energy, but to benefit from both the scarcities and excesses created by the energy revolution. Sheldon brings decades of deep expertise in the energy and utility sectors. And today we're going beyond just this moniker called AI power, which, is quite a buzzword these days, but we're going to really dive into deep substance. Please join me in welcoming Sheldon Simon to the podcast. Sheldon, thank you for joining today.
Thank you. This is great.
It's great to have you here, and obviously a very exciting time in your business and what you've been doing. But to get to today, I really would love our audience to understand how we got here, right? And you've been investing in the energy space for quite some time, and you've really built knowledge in this. Help us just give us a background a little bit into your career and the evolution of your career and how you've been thinking about the space.
Well, my career began a long, long time ago. 1984, I was hired by Putnam Investments as an analyst and then a portfolio manager. Left Putnam in 2002 to join Adage Capital. Those who don't know, Adage was spun out of Harvard Management Company, where it was set up where all the investors were investor analysts. So I was given responsibility for power generation, transmission, and distribution, along with gas transmission and distribution. That kind of kept the journey. I was doing that group for a long time, but that kept that journey going for a while. So I've been in this space forever. And in it, we see times where there are trends, typically multi-year trends, that drive the performance of these stocks and the structure of the industries. And we're undergoing one of those today.
What a ride on certainly the energy markets from the days of the 80s, right? The name T. Boone Pickens comes to mind, right? Those were the days. But it's been, I'm sure, quite a journey, and one that, we're very excited to hearing about, the key evolution. And I think really it's about, nowadays with obviously the energy sector has always been an important sector, but my goodness, how it's really delved into this really large, obviously secular trend around artificial intelligence and the need obviously for energy to power that. Would love for you to break down for us, there's just so many buzzwords around AI power and whatnot, but if you can help us understand it, from the perspective of the producers, the distributors, just kind of the value chain, what's actually going on under the hood and what are the different impacts, right? Economically and from an investor perspective.
So data centers and hyperscalers, which are the huge users of data, are new entrants into the power market. So typically power is being allocated by your local utility, whether it be someone like Con Edison in New York or Pacific Gas and Electric in California. They are the gatekeepers of electricity to homes, businesses, and factories. Now that's important because if you think about the planning process for these entities, it's long dated. They are basically almost like government entities, which is not necessarily a bad thing, but they think in terms of decades, in terms of their planning. So here come a massive change in the use of data, which requires a great deal of power. And the industry and the structure is not really set up well for that because you plan years ahead for power plants for adding capacity. And yet the change in the demand profile for data makes that demand changes almost instantaneous. So it's that disconnect between the time it takes to bring power to market and the need for power immediately that is driving a great deal of changing and creating opportunities for investors.
And from an investment perspective, and again, brings you back to the days of macro and microeconomics, right? Where you built your supply and demand curve, especially in the energy. And it feels like there's been a shift, right, in the demand curve, but the supply curve is somewhat fixed, right? So if we're thinking about it, maybe from somewhat that perspective, right, naturally someone's going to have to fill the gap, right? And I think what you're saying is it creates a great opportunity for investors, but what type of companies should investors be looking at that are going to help fill that gap between supply and demand?
Well, we have the independent power producers, companies such as Vistra, Constellation Energy, NRG, Talon Energy, whose business is to own and operate power plants that they sell into the marketplace. Those are the main forces. And some of the utilities have power operations themselves, but these tend to be big plants. They take a long time to build. they have available capacity, but when that runs out, what happens is power prices go up. And so that's what we're experiencing is upward pressure on power prices because the demand has increased so much.
But I guess just from a more of a fundamental perspective, is there enough power today to power? I mean, I understand that from a distribution perspective, the distributors may not have the capacity to deliver it, but is there enough source power, I guess, from the producers today to meet the demand of the users, of the excess,
There is, but you always want to have, and we've always ran with what we call reserve margins. So that typically, let's say you have 15% extra capacity just in case. Mm-hmm. And that's a good thing, but that amount of reserve capacity is diminishing as demand for power goes up. That will meet that demand. The question is how and when. So, for example, it takes 5 years to build a gas-fired plant from start to finish if it's planned well. Longer for nuclear plants, and so it's thinking going, well, how are we going to fill the need for new capacity? And of course, the new capacity costs more than what's established. So this is all upward pressure on pricing that we have to deal with.
So from an investor perspective, it sounds like you've highlighted, obviously, that the existing large power producers are going to probably be the primary beneficiaries because they have potentially the ability to add some capacity, right? Even though the reserve margin is coming down, and that obviously impacts their prices. So they're able to get more pricing power in the marketplace. Are there any other newer entrants that come to mind, in the space as you're thinking about the broad selection of in an investable universe of companies that could be interesting?
There are a number of startup companies, some with small nuclear technology that are there, but they're not ready to come to market yet. So we'll see how that evolves. There are also opportunities of companies that help the industry use power more efficiently. And then, of course, there's all the infrastructure build out that needs to go on. Because what we're doing is that we're adding capacity within a stable ecosystem of power transmission and distribution, and you want to maintain that, and that requires capital. So there's all sorts of ways to invest profitably, and you want to pick and choose what makes the most sense at any given point in time. For example, the power stock, clearly with the drivers in 2024. Will they be in 2025? Well, so far not so much, but there are other areas that will also benefit. So it is definitely a dynamic process looking at all the areas that are involved in power generation and distribution, and you want to see the ones whose valuations are first more compelling and their outlook is relatively undiscovered.
That's actually really interesting, and another kind of thoughtful segue into as an investor, right? And the first step is you have a lot of different opportunities to sort of dig into, like you said, and you're probably spending a lot of time you're researching. But then there's also a component here where you're thinking to yourself, okay, there are the companies right now that are going to be driven today by this. Maybe there are companies that are going to be coming to the fold in the next 6, 9, even 12 months, right? Based on the build out. There's, a portfolio management process, right? In order to be able to bring in those ideas, size them appropriately, risk manage based on, all the different drivers that are occurring. Obviously, you've been a portfolio manager for a long time and built an entire career out of this. How are your views changed on portfolio management, right? In this
It used to be in the energy space, people would be very focused, highly siloed what they're working on. So if you were a pure utility investor, you would just look at regulated utilities, maybe add a few things here and there. Elsewhere in energy, whether you're E&P, exploration production, or whether you're transmission distribution, they're all separate silos. So we've taken the point of view that the way to invest in energy for the long term is to look at energy inclusively across all subsectors, because in a way they're kind of merging in terms of what they are producing. Interestingly, this whole process began for me when I was an analyst looking at Enron, because Enron was actually the first to really look at energy and looking at different commodities, saying this is all the same. They did a lot of bad stuff, but that part was really a point of genius for them. And today, you can take that and say, I can look at energy through the prisms of all these subsectors, whether it be clean tech, exploration production of hydrocarbons, transmission distribution of hydrocarbons, power generation and distribution. And what that does, it gives you enough toys in the sandbox that you can build a risk-controlled portfolio that generates alpha on a more consistent basis. The challenge we've had with energy sector funds, I believe, is that it was too highly focused, and when things got bad, they got really bad, and most of these funds did not survive. So today, what's interesting from my perspective is that we're seeing an emergence of this sector being a very important one for both investors and the economy, and a dearth of experienced investors in the space.
Mm-hmm.
That's our opportunity.
That's interesting. It sort of reminds me back in 2005 when energy prices were rising after many decades of being kind of flat. And, we were seeing then people were talking about peak oil, right? And all that there was a dearth of just folks working in the energy industry, right? And they had to sort of figure out a way to hire more people. And, because over 20 years, it was sort of underinvestment, right? And talent was going elsewhere. So it sounds like on the investing space, right, there's an opportunity right now to have more people understanding how to do this. But obviously, you need to understand, like you said, more of a broad view. One maybe follow-up interesting question here about, it's great. You have a large sandbox to work from to select a lot of different subsectors and a lot of different lenses where you're talking about around energy. But is there different ways that you think about from a risk management perspective about the volatility characteristics, right? And we know that the E&P space can be highly correlated sometimes because obviously there's in the power space, right? And maybe in the utility segment, people really look at, one of the reasons they may be looking at only those names is because they tend to be highly correlated, and they can build a portfolio that's pretty well risk managed. When you're working across all these different segments, is there any different techniques or approaches that you've adopted for risk management because of maybe the various characteristics and volatility and otherwise of those names?
So the most important factors affecting this sort of sector portfolio is momentum and volatility. And I tend to be a sucker for those factors. So I have to make sure they are controlled. Right. And what we find by having all these different subsectors, they actually offset the factor risk of any one component. For example, the utility sector, low beta and less volatility versus, let's say, exploration production, which is high volatility. Even clean tech, volatile in itself, but a different kind of volatility than what you might see elsewhere in the energy sector. So they offset each other. And so when you put the portfolio together, you end up having a portfolio that has less factor risk in terms of volatility and momentum, which from my perspective means higher probability of being a successful long-term investment portfolio.
Right. Yeah, it's driven by less the vagaries of the market and what momentum investors want to do today or tomorrow, and more by your underlying fundamental thesis, because you're kind of netting out a lot of these exposures on a daily basis. No, that's really powerful, and makes a lot of sense, especially in your space, right? Given the beta and volatility characteristics of the companies. Well, this is phenomenal. And we, even in a short period of time, able to help us get a deep dive right into this very, very complex industry that obviously been around for a while, but has evolved quite a bit, and how, portfolio managers should be thinking about it. So really appreciate your time today, Sheldon. It's been a pleasure, and hope to talk to you again soon.
It's going to be a fun ride. So join the ride if you can.
Sure will. Right. Thanks again.
Thank you.
Thank you.